Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at General Dynamics Corporation, ticker GD. This is a stock that I used to hold. I had sold out of it a while back, and I had gotten an alert that it was at a 52-week low. So I wanted to check in on it, because sometimes that is the sign that it's a beaten down company that we can find some value in. So we're going to take a look and see if that's the case here. To start off, we see there's a little bit of red. We see their cost of goods was higher than their compound annual growth rate of their revenue over the last 3 years. Gross profit is down, net income is down, EBIT is down, gross profit percentage is down, net profit percentage is down. So the numbers that really truly matter are either low or negative on their 3-year compound annual growth rate, which is not really something that we like to see. This last year, they had a pretty decent year. Their growth came in lower than we'd like to see. Cost of goods growth was a little high, but it was still below what they had experienced in their top line revenue growth, so that's fine. Expenses rose quite a bit, which helped bring up their expense percentage of revenue, 0.51%, so that's a very high number. And outside of that, everything looked pretty good. So we're looking at earnings per share, valuation. The market seems to like this stock around 19. It's been higher more recently. Back in 2019, it was treated as a slower growth stock. And, well, it's showing slow growth still. It has picked up, but currently it's trading for 16.84 on a trailing 12 months, and we're looking at an average over the last few years of 19.32. So that means that the valuation for that metric would be around $235, which is $30 higher than it currently sits today. The book value is negative. It's trending towards a positive direction. Hopefully they'll be there soon. But there's nothing that we can really draw off of that. I don't like to see that. It means that their tangible assets are pretty heavy on their balance sheet. And then we have free cash flow. They are a monster with free cash flow. They've been growing it incredibly over the last 3 years. And that helps. A valuation for that, 20 times cash flow per share would give us $252.50 per share. Their dividend, they're a pretty low dividend stock. Their yield is 2.3%. With those heavy cash flows that they have, they could definitely grow this. 0.84 last year was dismal. They've been growing at 5.57% year over year. Hopefully they can get back on that trend, but for right now, we'd be looking at somewhere around a $223 valuation with that metric. So all of this breaks down to a fair value currently of somewhere in the 225 to 250 range. Based on the growth that they've experienced and what analysts are expecting, $12.66 for this year. They beat on their Q1 earnings, so they may come in higher than that, but that would only be 4% growth. And going forward, analysts are expecting them to bring in $14.79 the following year, and that would bring them to $285. That'd be 17% growth. That's so far out and so big for the numbers that we're seeing here. I doubt that'll actually happen. They'll probably be revised down, but just something to look at. Analysts do have some pretty big future earnings for this company. The earnings help bring an extra $10. Cash flow is so massive. It's because the compound annual growth rate is so large that if we only took the last year's change, that would also contribute $10. So we're looking for maybe $10 in growth of this stock on all metrics, which would help take our valuation maybe as high as $260. Now we can look at the chart and see what's going on there and where all of these numbers land. So here we have the chart. We can see that the stock is currently trading for just above $205. Dipped a little bit after hours. I tried to draw some more lines on it this time so we can see. I mean, a sell range would be somewhere above 30% above the fair value. Buy range would be at least 15% below the fair value, and the fair value line I have right about the $240 mark. So it's approaching that buy range if we take the numbers that we just saw. We see that it has a lot of resistance. It reached all-time highs around $256, and it is approaching a range where it's kind of met a bunch of support and resistance in. So it may be propped up around this $205 level. Let's look at these earnings and see what they have to say about those. Maybe they can give us some guidance. This stock, as I see it, low dividend, low growth, especially in the revenue. It's I don't see a reason to be holding this stock. It doesn't really fit into any categories. Say they came in 5.2% growth in revenue. That would be nice. We look for something above 5%. Hopefully they can hold that up all year. But we see the dollar value of that, $489. The growth in the operating costs and expenses, $459. So all of that growth is almost wiped out by their expense growth. Operating earnings up 3.3%. Earnings before income tax, so this is the EBIT, up 3.7%. EBIT, they've historically done, I mean, they've had a decline since 2019. Last year was up 1.15. Earnings per share, they came in at $2.66 compared to the $2.63 last year, which is 1.1% growth. And shares, they have been buying back shares, bought back a decent amount of shares. So the breakdown of these revenues, let's see if there was a decline in aerospace of 0.6% for the revenue, and pretty high expenses as well, which took them down 5.8% on their operating earnings. Oh, and operating margins. We see that their healthiest margins are on combat systems. Second best is aerospace. So that's the one thing we really don't want to see a decline in. We'd be fine if we saw a decline in marine system. And now we have the balance sheet. We are looking for total asset growth. Yeah, we see a small growth, 500,000. And then we see liabilities, non-current liabilities are up 100,000. So not a whole lot. And current liabilities are essentially the same, up 4. So in total, their liabilities are pretty flat. Shareholders' equity is up about 500,000 as well. That is nice. Cash flows. This is what's important for, like I said, this is the driver for this stock, is the cash flow. Net earnings are exactly the same. They were able to depreciate a little bit more, amortize a little bit more. Equity-based compensation expense was lower. Deferred income tax benefit was a lesser negative. It means it was higher. And then we can continue down. Net cash provided by operating activities, down 500,000 from last year. Cash flows from investing activities. They spent more on investing activities. Dividend paid. Of course, they paid more dividends. Much less buybacks than they had Q1 of last year. So they gave some nice numbers here. I like how they have their stuff laid out. Debt to equity, they're over halfway paid down on their debt. I mean, they progressed 1.5% in the last year. A book value per share, it looks like they've added about $2 in book value per share, which is something nice to see. Yeah, I had down in my sheet that they had 67.66. And this is over the first quarter. This isn't a year-over-year comparison. This is December to April. Free cash flows. Man, I wish every company did it like this. Down 500,000 as we saw. I know that they've received a lot of contracts and orders. So this runs through a lot of them. We don't need to look at all of them. If you're interested or hold the stock, it would be something good to know. So that's what we have to look at here. When I had first looked at the numbers, I wasn't sure how to feel about the stock with a low yield and low growth. I mean, it looks like higher growth is projected, them coming in with 5% growth. I mean, 1% in earnings. It's a low growth, small dividend company. Cash flows were down, so we'll see if they can bounce back with those cash flows. If they can bring this book value positive and get their top line revenue above 5%, ideally if they can get their earnings per share above 5%, I'd be interested in this stock. It's going to have to be a hold for me. Definitely not at sell prices. Honestly, it's approaching value buy prices, but with the 3-year CAGRs that we're looking at, I wouldn't even, if it hit value range, I wouldn't rate it a buy until they're able to start pulling it together. But with that, I want to thank you guys for please like, comment, subscribe. Let me know what stocks you want to see. I've got a few that I plan on coming out with this week. BTI, UNP, and AAP. I will put out videos like this on this week.